Hey everyone, Disney reported quarterly earnings yesterday and shares are up over 10.5%. But in this video, I'm going to explain why they had such a great quarter and what the company's forward outlook implies for future valuation. But first, I want to revisit something I said 3 months ago after their prior quarterly earnings call. I am so bullish on Disney, not necessarily in the short term, not from a trade perspective, but gosh, I may get a lot of flack for this, but I think Disney doubles way before Nvidia. I think Disney could double in 1 year. It's like an elastic band that's being stretched back, and it is set. It is almost there. It is almost set to be let go, with streaming turning profitable as I expect it to, and improve along with movies, and with the caveat that parks is no longer an overhang by spring. Then I think this is a stock. I think this is a stock that will work and really reward investors handsomely. I'd still rather own Disney than Nvidia. I'll explain why in the next video. But for now, let's just focus on the company's results, the outlook, and valuation. Okay, let's start with the revenue analysis for the quarter. This is what they did last year, right here, and then this is what they did this past quarter. I've got the year-over-year change in dollar amount here, and I've got the percentage change right here, along with some brief commentary. And again, the way I like to organize all the different segments is into classic Disney, TV Disney, and streaming Disney. It's just easier for me to think of the company in those three buckets, and then look at the segments within those. So here we go for classic Disney. Right, we knew it was going to be a big quarter for movies. Boy, was it ever! With Inside Out 2 and the Deadpool and Wolverine movie, the revenues were phenomenal, up 39% year over year. Just really, really super. Parks and Vacations, I should say. They were flat. They were up less than 1%. That's actually pretty decent, given the headwinds that management telegraphed to investors on their last quarterly conference call. They told us there were going to be some headwinds. They might even decline slightly, but they managed to have revenues go up year over year. So good on them. Products, that's your merchandise, up 2.3% year over year. Okay, that's fine. With movies up as strong as they were, maybe I would have thought that products would be up a little bit more. But again, the parks number, not that great. So overall, it's a fine number. Let's go to TV Disney. And again, this is your networks like ABC, Disney Channel, National Geographic Channel, and then ESPN is its own line item here. Network cable TV down a little over 6% year over year. It's another. I wrote it's another ouch, but totally expected, right? I mean, linear TV, everyone knows, is in secular decline. Everyone's cutting the cord and going to streaming. So down 6%. It's not great, but it's totally expected. ESPN was actually up 1%. That's pretty good. And then streaming Disney was up 15%, 14.8. Now, for the last couple quarters, Disney Plus and Hulu combined, the year-over-year growth had been trailing the growth of Netflix by a couple percent. This quarter, Netflix slowed down. They were at plus 17% last quarter, and then this quarter they slowed to plus 15%. And Disney matched Netflix's growth here on the streaming business. So that's really great. Disney Plus and Hulu closed the gap with Netflix this quarter, erased the gap. So plus 15% year over year, really solid. Overall, up 6.5%. With parks being flattish, 6.5%, it's really solid growth. Now let's go to profitability. We know that that Disney beat in the quarter, right? They posted earnings per share of $1.14. Street was like $1.03. I was actually at $1.20. We'll go through how their results compared to my forecast in just a minute. But let's look at their profit. Big picture. The year-over-year change in profitability, you had a nice pickup in classic Disney. It was totally offset by the year-over-year decline in TV Disney. So really, the difference in the quarter, the difference in the quarter was the streaming business, right? Disney Plus and Hulu year over year saw $673 million increase in profit, and lo and behold, the difference in the core Disney business segment profit was up 674. Now, okay, movies blew it out of the park. Look, year over year, they've been actually losing money for a number of quarters. They had inflected to positive last quarter, but look, up over 20% from -8 to positive 12.2%. I mean, that's just, as I wrote here, it's phenomenal. Parks, on flattish revenues, the operating margin went down 1.5%. But that's not actually understandable because they've let us know how much they're investing in their parks, renovating and putting in new attractions. And also, given the headwinds that they talked to us about, we did see a fair amount of discounting going on, especially for the resort down in Florida. So it's understandable that the profitability took a bit of a step back. TV Disney, ESPN, the revenues were up 1% year over year, but the operating margins went down. Not a great look. It looks like they have more costs to trim out of ESPN. I know Bob Iger is looking to negotiate a new salary with the Stephen A. Smith. Not a great time for him to be negotiating a new contract because ESPN is still spending too much money. The network, for network and cable TV, for a business that saw revenues decline 6% year over year, it's pretty much in line with what I was expecting. This was a huge step back in profitability. Now, investors have been looking past this business for quite some time. So it's not getting a lot of attention, and I don't really think we need to pay much attention to it either. But if we're being honest, this was a pretty awful result from an execution standpoint. Even as I wrote here, even after giving them a pass for being in such a secular decline, having your profit, shaving 10% off your segment profit on only a 6% decline in revenues is that's going to have to be addressed. I mean, that's just, there's no two ways about it. That's pretty awful. But the big news is streaming. They'd started to turn a profit a couple quarters ago, but the profitability here, I mean, they had talked about kind of eking out a small profit margin here. Mid-single digit, right? 4.5%. That's really solid, and that's well ahead of what even the most bullish investors were expecting. So net, a $674 million increase in segment profit, a 220 basis point increase in operating margins. Given the revenue increase, that's a 49% incremental margin. That's excellent. Really, really solid execution. We knew movies were going to be great. They were even better than expected. We knew the streaming business was making inroads in profitability, and that they were experiencing an inflection. But this was even better than expected. As far as what I was modeling, and this is, I think, important just to establish some credibility with you guys. I'm not just going off consensus numbers. I'm not copying other people, right? I spent 15 years doing sell-side equity research for one of the biggest, most successful investment banks in the world, and one of the most highly regarded investment banks globally for equity research. So really proud of the work I did there, and the skill set that I have honed. And yeah, I think I did a pretty decent job modeling Disney this past quarter. Not perfect, but pretty good. You're taking their guidance with kind of a grain of salt in some cases. But yeah, I'll go through it. Look, movies were great. I had trimmed my number a little bit. I shouldn't have, but they beat me by quite a bit. Overall, classic Disney beat me by 6%, but offset by worse than what I had modeled, TV revenues and streaming revenues. So net, Disney did beat me by $300 million, or 1.5%. So good on them. But they didn't beat me in EPS. And here's so that means, if they beat me on revenues, but they missed me on EPS, obviously that speaks to a larger miss on the profit margins. As far as classic Disney is concerned, I pretty much nailed the movie operating margin. I was at 12.3%. They came in at 12.2%. Was super close on parks and products too. I was 60 basis points ahead of them. I mean, we're talking, if we're talking a fraction of 1%, like that's really solid. They missed me slightly on ESPN, but close enough. The network number, which I spoke to before, was just a huge miss. Just a huge miss. And streaming was a big positive surprise, but not quite enough to offset, right? Like here's the actual difference. You can see, $288 million. I was too positive, and it's mostly offset by me being too conservative here, 202 million. But ultimately, they missed my number by 120 million. Overall, that's an 80 basis point, 0.8%. Super close. Pretty happy with this. But gosh, that network number really sticks in my craw. Super positive quarter though. That one number aside, and I'm happy to say that while they missed my number by just a smidge, it was a great super quarter for them. I've been positive on them for some time, and this quarter really is validation of them executing on all the themes that I had talked about in the video I made after last quarter's conference call. So let's just take a quick look here. Let me scroll down. 3 months ago, or 6 months ago, I talked about them. Here's a chart, them versus Netflix. But I had talked about them needing to improve profitability in streaming and in movies leading into last quarter. And after last quarter and this quarter, they've really done that to the tune of over 500 million, 316 for one, and I think it's 250 for the other. So really solid. Movies, we absolutely knew that movie profitability was going to improve with the blockbusters that they had. And look at this, the black line. How far Disney plus Hulu, the profitability, how far they've come from losing $1.5 billion per quarter to now making $250 million this last quarter. Really impressive, really solid. Right, movies in particular, right, this was a money pit for them. Now movies have been profitable for 2 quarters in a row, and they've got more new releases coming out before the end of the year. So that segment has truly flipped the script. Moving on to streaming, this was a major headwind for shares. They had lost almost $1.5 billion in a single quarter. Now, over time, it was getting progressively less bad, but this past quarter is what really showed investors that they finally turned the corner. Now, what does this mean going forward? The company has given us some earnings guidance going forward. They did $4.97 in EPS this last year, and the company is guiding to high single-digit EPS growth for next year, fiscal 25, and then accelerating to double-digit EPS growth in 26 and again in 27. Now, I think management's being a little conservative right now for fiscal 25. I've got them growing 10% next year. And I've got them growing 15% in 26 and again in 27. So on my numbers, I have them getting to 723 by fiscal 27. And if you take the PE multiple for the S&P 500 today, it's almost 28. You take that multiple and you apply it to Disney's EPS in 27, you get shares that could be worth $201.50 3 years from now. So what we have to do is discount it back to today, we have to discount it 3 times, 3 years, at 7.5%, which is their weighted average cost of capital. And that implies a current valuation of nearly $162 a share. And with shares at 113 today, that implies upside of 43%. So even if, even if you missed out on the 31% move over the last quarter, it's not too late. There's still a lot of upside left for investors to take advantage of. Now, in the next video, I mentioned I'm going to take a side-by-side comparison of Disney versus NVIDIA and why I continue to like Disney more than NVIDIA, even at current levels. And yeah, I hope you've enjoyed the video. Please like, share, subscribe, and until next time, take care.